Hi and welcome back. I am Moumita and in today's episode we will talk about all the important events from last week. Moving to USA, the minutes of the Federal Reserve Monetary Policy meeting which was held earlier this month was released last week. The minutes was hugely awaited as the markets were trying to guess if there is a possibility of a 75 basis point rate hike in the June or the July policy meeting. From the minutes, it seems that there is a 50 basis point rate hike on the cards in June and July. The balance sheet normalization is also likely to begin sometime later this year. So the borrowing costs will rise even further. Moving to India, last week the markets remained volatile the entire week. Sensex ended with 1% up and Nifty was up 0.5%. To provide relief from the high commodity prices, the Indian government has taken a series of steps. The excise duty on petrol and diesel were reduced. So the prices of petrol is to go down by rupees 9.5 per liter and diesel by rupees 7 per liter. Rupees 200 subsidy on LPG cylinders has been provided under the Ujjwala scheme. The export duties on iron ore and steel products were increased. Custom duties on plastic and steel was reduced. The RBI is likely to increase the policy rates in the monetary policy meeting to be held between the 6th and 8th of June. The RBI is also expected to revise its inflation projections during the policy meeting. How to strategize the portfolio? An interesting graph from head of global R&D multi-asset Alliance Global Investors shows that the short-term correlation between stock and bonds is really not zero. In the long term, this holds true. That is, the correlation between stocks and bonds is zero. So in the long term, having a portfolio of stocks and bonds is good diversification. But that is not the case for the short term. Another blog by the head of fixed income of IDFC mutual funds show that they do not favor bond strategies anchored around 1 year. Rather, they prefer the 4 to 5 year sovereign bonds which are showing decent duration risk adjusted return. So, my take is if the investor can be invested in the market for the medium term, then a stock bond diversified portfolio would be helpful. However, if the investment is for the next year, then the portfolio should be biased more towards the stocks. That is all for now. Thank you for listening. I am Moumita.